Good evening, and I'm Salma El-Fiki, and welcome to Qnews Economic Bulletin. We bring you the latest top economic stories along with expert analysis on the events and trends shaping the regional and global economy. Throughout our coverage, we spotlight key sectors and highlight the defining economic developments of the moment. To start with, the latest headlines, we'll hand over to our colleague, Hani Saif, for the top economic stories. What do you have for us today, Hani?
Thank you, Selma. We have plenty of news and developments from around the world, but we'll start off with Europe, where the European Commission has approved a €2 billion capital injection by Hungary into state-owned Magyar Bank as Budapest commits to improving governance standards in exchange for access to EU funds. The Commission said Hungary agreed to measures aimed at limiting the bank's activities to areas where there are market gaps and preventing unfair competition with private financial institutions. The decision comes as the EU moves forward with Hungary's recovery plan, which could unlock around €10 billion in previously withheld funds linked to concerns over corruption. The European Union has announced new sanctions on Sudan, targeting the country's gold trade in an effort to curb funding for the ongoing conflict. The measures include a ban on the purchase, import, or transfer of gold originating in Sudan, as well as restrictions on the sale, supply, transfer, or export of mercury and cyanide to the country. The EU says Sudan's gold sector has been used to finance the conflict between the Sudanese army and the paramilitary rapid support forces. In inter-trade relations, Britain and Switzerland have agreed a landmark trade deal aimed at boosting services, digital trade and business mobility between the two countries. The agreement will allow professionals to travel visa-free for up to 90 days a year and enables UK companies to transfer staff to Swiss offices for up to 5 years. Both sides also plan to eliminate mobile roaming charges, while UK nationals are expected to gain access to Swiss airport e-gates. British officials say the deal could increase UK exports. British Finance Minister Rachel Reeves has warned that Andy Burnham must have a worked-through plan before taking office as the country's next Prime Minister. Reeves backed Burnham's leadership bid, saying he was the right person to lead the Labour Party and take on the challenge posed by the populist Reform Party. Burnham is expected to replace Keir Starmer after securing overwhelming support from Labour lawmakers. He's set to be formally confirmed as Labour leader next week and become Prime Minister on July 20th.
Him and his team, that he wanted at some point to lead the Labour Party, and I want him to be ready for that because I want him to be a success.
German Chancellor Friedrich Merz has called for dialogue with China over Beijing's currency policy, warning that Europe cannot compete against a rival that artificially influences the value of its currency. Speaking at a German university, Merz said the European Union was seeking talks with China to encourage greater flexibility in the yuan and fairer competition in global markets. He said Europe must address the issue through dialogue while maintaining competitiveness in trade and investment.
Es ist zugleich eben auch eine gute Nachricht für die deutsche Wirtschaft. Mr. Marcani hat in der
OPEC has lowered its forecast for global oil demand growth in 2026 for the third consecutive time, citing uncertainty over the global economy and energy markets. The producer group now expects demand to rise by 780,000 barrels per day next year, down from its previous estimate of 970,000 barrels per day. OPEC said global economic growth has remained resilient and raised the demand outlook for 2027 while noting that geopolitical tensions and disruptions to energy flows remain key risks. Oil prices rose more than 4% on Monday after U.S. President Donald Trump said the United States was reinstating a naval blockade on Iran, reigniting concerns over energy shipments through the Strait of Hormuz. Brent crude futures were up 4.22% to $79.22, while the U.S. West Texas Intermediate crude was up 4.26% to $74.45 a barrel. Both contracts jumped 5% after Trump said the U.S. was reinstating the blockade following renewed military exchanges between the U.S. and Iran. Gold prices fell nearly 3% on Monday after U.S. President Donald Trump said he was reinstating the naval blockade on Iran, boosting the oil markets and reigniting inflation concerns and raising prospects of higher for longer U.S. interest rates. Spot gold was down 2.8% to $4,005.59, the lowest level since July 1st. Prices were down for the second straight session, and U.S. gold futures were down 2.4% to $4,013.4 an ounce. Those were the top economic and financial stories we have for now, but let's head back to Salma Al-Fay in our studio. Salma.
Thank you, Haney. And now we move to our in-depth analysis. Can the West afford to de-risk from China? A new EY Parthenon analysis reported by the Financial Times puts the price tag at $23.6 trillion by 2050. But with China still dominating the supply of critical minerals, is economic independence achievable or simply too expensive? Let's take a closer look. Financial Times has reported that Western economies face a $23.6 trillion investment challenge by 2050 as they seek to reduce reliance on China in strategic industries. Citing an EY Parthenon analysis, the report estimates the U.S. would need $13.7 trillion, the Eurozone $9.1 trillion, and the UK $800 billion over the next 25 years to rebuild manufacturing, technology, research, and supply chains currently linked to China. It noted that the additional investment averages about $940 billion annually, underscoring the scale of efforts to strengthen economic resilience. The report also found that China remains deeply embedded in global supply chains for critical minerals, complicating Western efforts to reduce dependence. China is projected to supply more than 60% of the world's refined lithium and cobalt, and around 80% of battery-grade graphite and rare earth elements by 2035. It added that Beijing's export controls on rare earths expose the vulnerability of the U.S. and European industries, while China's 20 to 100% factory price advantage could raise costs in key European sectors by 1 to 2.5% and keep inflation above the 2% targets of the European Central Bank and the Bank of England. And for more analysis and details on this topic, we are joined from Hong Kong by the PhD researcher at the University of Manchester, Mr. Marvin Lee. Welcome, sir, to Q News. Sir, the EY Parthenon estimates the US, Eurozone and UK will need an additional $23.6 trillion by 2050 to reduce dependence on China. Is this level of investment economically realistic, or does it reflect the true cost of the economic security, sir?
Assalamu alaikum. Takabala Allahu ta'atikum wa saliham alaikum. The figure is economically possible in theory, but politically and practically extremely difficult in the real world. Let me explain why.
Okay.
Spreading over 25 years, 23.6 trillion US dollar would amount to roughly 944 billion in additional investment every year. And this would come on top of existing spending on defense, aging populations, healthcare, infrastructures, AI, and energy transitions. So therefore, I would not interpret this figure as a realistic government budget. It's better understood as the estimate cost of trying to reproduce on a very, very large scale and the industrial capacity that China has built over several decades since in the 1980s. From the Chinese perspective, the figure demonstrates that China's supply chain position is not based simply on cheap labor and is based on accumulative infrastructures, engineering expertise, logistic networks, supplier relationships, capital investment, and a very large domestic market. And how can the Western world and Japan and Australia replace China within 25 years and talking about that their government will be changed or replaced every 4 to 5 years, and the policy is not consistent. They have no consistency in the internal policy like the one in the UK right now.
Sir, the report also focuses on rebuilding manufacturing supply chains and technology ecosystems. Which of these areas should governments prioritize first to achieve the greatest strategic impact, do you think?
Governments should prioritize critical supply chain bottlenecks rather than attempting to rebuild all manufacturing. The greatest strategic impact would come from investing in mineral processing, rare earth separation, permanent magnets, battery material, semiconductor inputs, advanced machinery, and recycling technologies. The key problem is that processing mineral resources does not mean processing the industrial capacity to use it. A country may mine lithium or rare earth, but the material may still need to be sent or shipped to China for further refining and processing. So in a very short, a medium, and very long term, I can't see that the Western world could be able to successfully replace the China's demand, and it is too late now.
China is expected to maintain dominance in refining lithium, cobalt, graphite, and rare earths through 2035. How difficult is it for the Western economies to diversify these supply chains, given the time, cost, and environmental constraints?
First, there is a time constraint here, and we can see there has been an AI race between China and the West. China and the United States of America, and the second generation of space race, and the very unprecedented technological race between these two countries. And whether you produce F-35, AI, microchips, computer, laptop, you need rare earth. And there's only one country that can produce, that can take the rare earth, extract the rare earth, and even to export the rare earth, and that is China. And then always, and then one more extra point that I would like to add is China's Belt and Road Initiative is a very successful one in terms of acquiring lots of mines, rare earth mines, mineral mines across the rest of the world, especially in the global south, like the one in Kenya and Angola, in Africa, in South America, in Australia. That's why there was a new seaport in South America in order to transport all the raw materials from the original source to the seaport all the way to China. But at the same time, the US and the Western allies and even Japan have a very less level to purchase all these gold mine or mineral mines in comparison to China's capacity. I can see China is playing a long-term game, and China is very successful and is really good at to do so.
Last year's rare earth export restrictions exposed maybe the vulnerability of the US and European industries. What were the biggest lessons from that episode for the policymakers and manufacturers?
The first lesson is that the ownership of raw material is not enough. The real vulnerability lies in processing, separations, the production, and the permanent manufacturing. And also, this also relates to the second lesson, and this also relates to environmental concern. And the EU and the United States of America have lots of regulation regarding the environmental protection. And China, they have they have the relevant law, but they are very flexible to utilize rare earth as a tool to bargain more during the negotiation table. So let me clarify here. Around in the 1970s or 1980s, China used to be a very poor and vulnerable country, and they need lots of foreign currency. And China was the only country to agree on this rare earth mining, which also harms our own environmental our environment as well. Water pollution, air pollution is a huge problem in Inner Mongolia, in the northern part of China, even nowadays. But the Western world have been enjoying all this unequal advantage. But nowadays, they would like to bypass China. And I don't think these people, they are very rich in terms of the GDP per capita. They would like to agree or even witness the rare earth mining within their own territory, because they have a double standard.
Unfortunately, Mr. Lee, I'm running out of time. From Hong Kong, that was the PhD researcher at the University of Manchester, Mr. Marvin Lee. Thank you so much, sir, for your insights. And now we turn to the fans' favorite, as all eyes remain on the 2026 FIFA World Cup. While the action unfolds on the pitch, the tournament is also reshaping the way people spend, travel, and do business. From short-term rentals and local bars to digital platforms and small businesses, the World Cup is highlighting the growing role of the sharing economy in global sporting events. And let's take a closer look. The 2026 FIFA World Cup has become Airbnb's biggest hosting event ever, surpassing the Paris 2024 Olympic Games. Airbnb said more guests are staying in homes booked through its platform during the tournament than at any previous global event, as thousands of homeowners opened their properties to visiting fans. In Massachusetts, some first-time hosts earned thousands of dollars by renting their homes near Gillette Stadium, with many saying the extra income helped cover mortgage payments and household expenses. Independent data from AirDNA shows the tournament is generating strong demand for short-term rentals across Greater Boston. Demand increased by 9% during the opening weeks of the World Cup, while occupancy rose to 81%, despite the addition of around 1,000 new listings. Average nightly rates climbed by roughly 25%, helping hosts generate nearly $57 million in rental revenue. The benefits extended beyond accommodation. Beer sales in Massachusetts rose by more than 25%, while some bars reported sales increases of between 30 and 50% as fans gathered to watch matches. Boston also recorded the strongest growth in restaurant spending among all U.S. host cities during the opening weeks of the tournament. And despite the surge in spending, economists remain divided over the tournament's long-term economic value. Supporters argue that platforms such as Airbnb are allowing more local residents and small businesses to benefit directly from hosting a global sporting event. However, some economists caution that part of the increase may simply reflect displaced spending, with World Cup visitors replacing the region's usual summer tourists rather than creating entirely new economic activity. They say it remains too early to determine the tournament's overall net economic impact. And joining us now is Mr. Bram Gallagher, the Director of the Economics and Forecasting at AirDNA, whose company has been tracking short-term rental performance across World Cup host cities throughout the tournament. Welcome, sir, to Q News. It's great to have you with us and hope you're enjoying the tournament.
Thanks so much.
Let me ask you, sir, first of all, before we get into the numbers, can you briefly explain how AirDNA measures demand and occupancy and revenue, and why your data provides such a reliable picture of what's happening in the short-term rental market during an event like the FIFA World Cup?
No, exactly. No, what we do is we scrape the web for all kinds of short-term rental listings. Airbnb is one of the sites that we scrape, but we also look at Expedia, VRBO, Booking.com. We try to get a holistic and exhaustive picture of the short-term rental market. This is a global operation in the U.S. We think we get around 90 to 95% of all the short-term rental activity via this sort of web scraping. Our customers depend on us for accurate intelligence, so we try to keep it as factual and as close to the truth as we can.
Airbnb, sir, has described the 2026 FIFA World Cup as its biggest hosting event ever. From AirDNA's perspective, what have been the biggest trends in the short-term rental market during the tournament?
Great question. It has been a success from a short-term rental standpoint. We've definitely seen demand increase across all of these host markets. One of the interesting things that's special about this event is that, unlike, say, the Paris Olympics, which it did include many cities but was really centralized in Paris, here we've got many different cities, and it takes place over a long period. And I think the combination of those two is really where you saw a lot of individuals hosting, and why this event was so large for Airbnb and other short-term rental platforms.
Yeah. Well, your data shows strong growth in demand, occupancy, and nightly rates across Greater Boston. How significant are these increases compared with other major global events you've tracked, including previous World Cups and the Paris Olympics?
For Boston, we have very good demand growth of around 11% for all of the game days and game eves, which is pretty impressive. As you said, 81% occupancy. Occupancies for short-term rentals run a little bit cooler than hotels. So that 81% occupancy is quite strong. Mm-hmm. Something else that we've noticed too is that for this World Cup, the ADR, or the average daily rate, that's the price of a night. Now that's where we've seen a lot of movement and a lot of growth. And Boston was no stranger to that, seeing about 25% higher rate. And that's very impressive considering it's one of the most expensive host cities, seconded only, interestingly enough, by Kansas City, which has seen enormous growth in their short-term rental supply. So it's a completely different market than it was a few months ago. But Boston, on average for one night, it's about $312, and that is in excess of the $251 from the same period last year. So that sounds expensive, but keep in mind too that I think one of the reasons why short-term rentals have seen such interest in this World Cup is it is an expensive World Cup. And this was one way that we could save money is by controlling where we stayed. even though $312 a night is pretty expensive, we also keep in mind that each one of these listings has about between 2 and 3 bedrooms on average. So if you're traveling as a family, as a group of fans, as a group of friends, there can be some real savings over individual hotel rooms.
Sure, yeah. One of the most interesting aspects of this World Cup is that many first-time hosts open their homes to visitors. The tournament encouraging more people to participate in sharing economy, can we say that?
I think so, yes. In Boston, we saw, as you pointed out, about 1,000 extra listings. That's a 10% increase. So it's not as monumental a shift as we saw as far as the number of listings as we've seen in some previous events, like, say, for instance, the Paris Olympics, where we added a lot of listings to Paris, almost doubling sort of the capacity. On the other hand, something about the U.S. host cities, at least, is that many of these places were already very well stocked with lodging and accommodation. So we did see some people trying out the short-term rentals, trying out hospitality. So there was an increase, but also a lot of people that had been in this market and operating this market are appreciating some of the additional revenues generated by the World Cup as well.
AirDNA's data shows that around 1,000 new listings entered the greater Boston market during the tournament, yet occupancy still reached 81%. Were you surprised that demand remained so strong despite the increase in supply?
No, I was. This was about in line with my expectations, and I knew the short-term rentals were going to do very well for a variety of reasons. One is that price and value reason that I already spoke to, but another thing too is that, you know, when you're traveling long distances, perhaps to spectate some of these world-class games, so a lot of the amenities that short-term rentals have become incredibly valuable as well. So things like, you know, having on-site laundry and kitchens. So I knew that, you know, that this was going to be a great event for short-term rentals. There was going to be a lot of demand, that they were probably going to be, you know, very, very desirable, particularly ones convenient to the venue. So that actually made a lot of sense to me. The growth in the listings, that 1,000 listings, it was a little bit more sedate than maybe I expected. As I said, it was a little bit smaller growth as far as the number of listings.
So you actually expected more?
Well, it could be. It could be. It's so we added 1,000, but again, it's a market of around 11,000. That was last year. About 11,000 listings last year.
Okay.
So, you know, it is a pretty well developed market. On the other hand, one of the things that we have noticed is that many of the new listings that are coming online are being made available after the World Cup as well. So it may be the case that, well, we see a smaller bump here than maybe we expected, but there does seem to be the potential that these short-term rentals are going to stick around for longer than just the World Cup.
Just the World Cup, yeah. Did Greater Boston stand out among the World Cup host cities, or are you seeing similar trends across North America?
Well, I would say it was about in the middle of the pack as far as the demand growth goes. The occupancy lift was very nice, perhaps because the listings growth didn't sort of get out of control. And the rate growth being 25% is not the highest on a percentage level, but again, the rates in Boston are pretty expensive, so it gets pretty hard to increase rate by a really large margin. For example, some of the Mexican host cities were priced more affordably than a lot of the American markets, and they saw extremely high rate gains. You know, so Guadalajara 82%, Monterey 89%. But they're still priced well below what Boston's per night ADR was. So the fact that we started at this $250 a night rate and then we increased that another 25%, I think is very impressive.
Looking beyond the World Cup, I know you mentioned that the listings would stay longer. Do you expect many of these first-time hosts to remain in the short-term rental market, or is this just largely a one-off time opportunity? And how do you see the sharing economy reshaping the way future mega sporting events are hosted?
Well, I can answer the second question first, if that's all right. But
yeah, that's okay.
We saw this in past events, and we also saw it in the Paris Olympics and Super Bowls here in the U.S. What happens is that these short-term rentals, I think, play a really important role with these mega events, as you say. because the supply is flexible. So, if you got a smaller lodging market, you might think, well, might not be able to accommodate all the visitors. However, the short-term rentals, they can expand the supply pretty quickly and help accommodate those things without having to build lots and lots of infrastructure. I sit in Atlanta and I tell this story frequently, but 1996, the Olympics came to Atlanta and we built tons and tons of stuff for the Olympics. And then after they left, many of these sort of hotels had a lot of additional vacancy. But here, you don't have to build out infrastructure. You can put money into the local economy, as short-term rentals are by far and away owned by locals.
Okay. Unfortunately, Mr. Gallagher, I'm running out of time. That was Mr. Bram Gallagher, the Director of the Economics and Forecasting at AirDNA. Thank you so much, sir, for your insights. That brings us to the end of our economic bulletin for today. Thank you so much for watching, and stay tuned to Q News for the latest updates from the worlds of business, finance and global affairs. Don't forget to follow our coverage during the World Cup, where we'll go beyond the action on the pitch to explore the business of the tournament, from sponsorships and investments to tourism, trade and the economic impact of the world's biggest sporting event. And I'm Salma El Fiki. Thank you so much for joining us, and have a great evening.